Hi folks, thanks for joining us today. Welcome to the Retirement Education Center of North America. My name is Mark Cardoza, and the topic today is paying for long-term care options and strategies. So let's go through a couple of housekeeping items first. The stuff we're presenting is reserved for our rights, and if you want to use the material, we're all about sharing information, but we just want to make sure who we're sharing it with and what we're sharing. So just reach out to us, and we can help you out with whatever you need and work with you. Today's information is broad-based purpose only. We are here for you. If you want us to tear apart a policy, talk about things, or think through an issue, that's what we're all about. We're a group of resourceful people. Question and answers throughout the whole thing, please chat them off to us. We'll try to answer them throughout the webinar and also at the end, and if you need to, send me a note, an email, or whatever. And it was great talking to a bunch of people with you yesterday, and I'm glad to see that you're here on the webinar. All right, so feel free to shoot us some questions. What is the Retirement Education Center? It's real simple. We're a group of professionals that have informational tools, professional resources, and we're trying to help you understand and put together a comprehensive retirement plan so that you can live comfortably in retirement and enjoy life. One of our major assets is a book called Position for Retirement, which because you're registered and attending the meeting, we're going to send one off to you digitally after this. And also, if you need a physical copy, please feel free. I can send you a copy in the mail, and we can go from there. It's been recognized by Yahoo Finance, U.S. News and World Report, Investment News, Business Weekly, and a bunch of other national media platforms. We're very proud of it, and it's helped a lot of people over the last 5 years. We continue to put out more information as well. Today is a program called Options and Strategies for Paying for Long-Term Care. We have a brochure that I can send you as well, and physically or in your email that can help you understand the content of this and review it. And afterwards, once we have all this done, we'll send you a YouTube video of the entire presentation. So anyway, let's get on with paying for long-term care options and strategies. So as you probably know, and a lot of people on this call have had experience with long-term care planning, and either personally or friends, or may have an advisor that is saying, hey, you know what, you need to look at long-term care because that may be an issue. 85%, I guess that's the number these days, 85% of our population is going to need some form of long-term care. So it's important to prepare for it instead of, a plan is a great thing. No plan is not a good thing, so it's important to plan. So that's what we're going to talk about today. And when the time comes, who's going to help us and how we're going to pay for that, how we're going to pay for our care or the extra things that we need. So that's what we're going to talk about. But before we get started, we're going to do a brief overview, not a long one, brief overview of what a long-term care policy is all about, or plan. It doesn't have to necessarily mean it's an insurance policy, but we need some kind of a plan put in place. So a long-term care plan is the process of organizing and creating financial and physical resources for our caregivers. Okay? We will be, if the plan is for us, we will be the people needing care. So we will have caregivers, and a lot of times it's our children and grandchildren. My mother is 90 years old, and my children are as active in her care as my wife and I are. So it's important to have things in place, as you get older, and hopefully you live a nice long life, and hopefully the care will be in place if and when you need it. So that's what long-term care planning is all about, and that's putting that plan together. Okay. What's the long-term care going to do for you? Well, it's going to help you as an individual relieve your stress and pressure, knowing that you're not burdening your family. So that seems to be a big thing. I've been in this industry for like 15 years, and I always hear people saying to me, well, I don't want to be a burden to my children. I hear that all the time. And I'm 62, and my mother's 90, and she's not a burden, but she still feels that she is. She comes over our house for dinner, we pick her up, we do things for her, but she feels that she's not as independent anymore. That's what she's telling us. So putting together a plan, who's going to shop for her, who's going to help her with her chores, her laundry, getting her to get her hair done. All those things is an important thing to put in place. So it's going to release her stress when she knows she has everything down pat. And it's got to give her a level of dignity knowing that she's done everything she could possibly do to provide us with the resources that she needs when she gets older. Kind of makes sense, okay? And one of the other things that a long-term care plan does, we're going to plan to protect your assets, okay? There are several ways of protecting them. There's insurance policies, there's legal ways, so there's all types of ways. So, but this webinar is basically talking about how to pay for a long-term care plan. But that's one of the things a long-term care plan will do. It helps you protect your income and assets that you worked hard to earn. Okay, so most people want to be cared for at home. Okay, and what happens then is the caregiver, again the giver, and a lot of times picture yourself and your spouse if you're married. One person needs care, the other person is giving the care. So you might be 85 years old, and your spouse might be 87 or 82 years old, and the care might go on for an extended period of time. And I know I'm preaching to the choir. You probably already know this. And the next thing you know, the caregiver gets sick. So caregivers are vulnerable, and they also may need care as well. So there's that problem there. You've got a balancing act. My father needed care. My mother cared for her for a year and a half, and him for a year and a half, and before he passed away. And then we were concerned so we tried to take the work off her and spread it out over my family and my brothers and their wives and so forth. So oftentimes the care is left on the shoulders of one family member. We see that a lot. There might be one family member local. There might be family members in Florida, California, in Europe, wherever they are, and one seems to be the support person. But you try to balance that out and try to do something special for that family member that's doing all the care. And sometimes siblings can build resentment because one person is doing it all, and he gets upset with the others because they may not be pulling their weight. So it's important to have that plan and understanding up front of what those siblings can be doing for the one that's doing all the weight, pulling the weight. Maybe they could be doing something on their end, which doesn't mean being there, but they could do something. And it kind of makes them fit into the puzzle, and it helps alleviate and eliminates these concerns. So I'm working with a couple of families right now, and one of them has 3 children, and the one is in control. She's the leader of the 3, and they have a schedule. The couple is still living in their home, and one of them is taking care of the maintenance of the house and the grounds, and the other one is taking care of the health and so forth, and the other one is a handyman, so he's taking care of a lot of doing things around the house as well. So, but they've got a good system going on. This summer, they were actually able to go on vacation, which was a kind of cool thing. So they're working well together. It's nice to see because you don't see it often. It's too bad. So what will the caregiver need for resources? Okay, so we have this thing called custodial care. So when you are in need of care, you may need help bathing, dressing, toileting, cooking, shopping, going to the bathroom, whatever. All right. Those are what we call the custodial care parts of a long-term care plan, and they're also referred to as activities of daily living, or ADLs. Okay, so that's an important thing to understand the custodial care, because when you're talking to people, they'll say, well, do you need custodial care? Do you need skilled care? What type of care do you need? Do you need personal care? So these are the things, these are the terms you might want to become familiar with. There's home modifications that may need to be done. You might need shower bars. You might need stair rail chairs. Those are really cool. If you've ever ridden one, they're kind of cool. You might need a ramp put in. They're portable or permanent. And this medical alert system is awesome. If you fall down, it calls somebody and they come pick you up, or it calls the police department and an EMT comes in and visits you and picks you up. Those are very important things. And we need them all. Adult daycare is huge. All right. One of the things as we get older is socialization. That's the number one thing that people as they get older are concerned with. Who am I going to see? My friends are passing away around me, and I need to find more friends. So going to an adult daycare is a great solution. And we have some public and private programs. All right. PACE which is a public program. It's a combination of Medicare and Medicaid, so you have to qualify for it to create the specific copay. Everyone does qualify for it, your copay gets higher. But it's a great program, and they have in-home programs, and they also have programs daycare programs where they'll pick you up at home, bring you to the daycare, and then bring you home, and they feed you snack and lunch in between. It's a great program. Then there's also elder care services. You might have somebody come in and help you do your laundry once a week. It's usually 3 or 4 hours. I think 4 hours is a really good thing if you can get that, but usually between 2 and 4 hours a week, they bring people into your home. So these public programs, you always want to make sure that you're incorporating into your long-term care plan. There's other types of public programs. There's community programs. You might reach out to your church or your synagogue. They might have things that they could offer you. The town oftentimes has programs, transportation, and things like that. So we always want to incorporate those types of things into our programs. Now, assisted living, all right, and skilled nursing facilities. I refer to assisted living as living in a resort. When you go by these places, they're beautiful, and if you want, stop in, take a tour. They're incredible. If I have to leave my home to be cared for, that is a great place to go. Home care is always the preferred way of getting through long-term care, but the assisted living is a really nice place to go to. They're beautiful, and they're beautiful. They have all kinds of, they have activities, they have transportation to and from places, they have indoor activities, outdoor activities, that your family member is monitored. It's a very secure feeling, and the people that go to assisted living tend to enjoy it because they're socializing, and that's a big thing. Nursing home care. Nobody wants to go to a nursing home. I've only met one person. That's how I wanted to say, I don't mind going to a nursing home. All right? I work with a lot of nursing homes. I'm a court-appointed guardian in the state of Massachusetts for 2 individuals in nursing homes. So I see nursing homes a lot. And they are a medical environment. All right? This is I call it a resort environment. This is a medical environment. I don't know anybody that wants to go into a nursing home except for that one person. And the kicker is this, even cognitive care and Parkinson's, there are assisted living facilities, communities that will accommodate those illnesses or those diseases or those problems. So there's so many options, and as we get older, there are going to be more options. And how do we pay for these? Because we don't want to be left out in the cold without any care or without a plan. Okay, first of all, we need a care coordinator. Okay, where do I find this? Well, I'm working on a file with a man, his wife has dementia, and where his policy is a long-term care policy, it's a group policy, and he doesn't have a care coordinator. So we have to find a care coordinator for him to help him organize everything. And so we go through that with him, and we're working with him, and we're developing that. A lot of independent long-term care plans, independent as opposed to group, have care coordinators assigned in the policy. The policies either have a physical one that's going to meet with you. Those are the older policies, but the newer policies, they help you over the phone. They'll tell you where to get those wheelchairs. They'll help you find that in-home care. They'll help you find, and they'll help you sort through the process over the phone and go from there. But if you need a care coordinator, you're welcome to reach out to us, and we can help you work through that process. We do it all the time. So having a care coordinator, you're not alone. If you don't have a long-term care plan, you don't have a care coordinator. So no long-term care plan. Some group policies don't have care coordinators. So reach out. We're there. We can help you. We've been through it. It's not our first rodeo. So anyway, who's going to pay for this? Medicare? Wrong. Nope. So Medicare is a health insurance. So when you go to the doctor, you go to the hospital, they help pay for that. Sometimes they pay for your medication. So usually a few days in the hospital. I think it's 3 days in the hospital, admitted, not observed. Then the doctor sends you to a rehab, and up to about 100 days, and Medicare and your supplemental insurance generally will pay for that. After that, you're on your own. Okay, it's out of pocket. Okay, if you have immediate care, if you need immediate care, now that's care. You go to the hospital, or you need PT, OT to come to your house, or somebody to come to your house that's medically driven. They're going to pay for part of that. But after a certain period, when the doctor says, I think you're well enough to do some work on your own, and you feel like you're not, then you're going to pay out of pocket from that point on. So how are we going to pay for these areas? Custodial care, remember what custodial care is? Let's go back. Custodial care is bathing, dressing, toileting, cooking, shopping, all right, those kind of things. And we could possibly get some help from elder care services, but that's about it. So beyond, at that point, custodial care is all out of pocket. It's going to come out of our long-term care plan, whatever that might be. Okay, so let's talk about what that might be. So let's finish this up first. So let's go over it. Medicare, not going to help us out, not much at all. It might help out a little bit with PACE, but not really much. Medicaid, after we spent down our savings, you talk to your attorney, your CPA, they're going to tell you, well, once you hit about $2,000 as an individual, then Medicaid will step in, and 9 out of 10 times you're going to end up in a nursing home, and that's not the place everybody wants to be. Social Security, all right, Medicaid does not pay for Social Security, long-term care. They suggest looking at private insurance, and it's on page 4 of your statement that you receive every year or two from the Social Security Administration. So they're upfront about it. They tell us. So we're not getting a lot from anybody from the government unless we've written down our assets to, I think the spousal one is like $120,000, $130,000. So after that, we can get help. But beyond that, so if you take $1 million, you have to buy it down to like 120 before they're going to help you. So that's not a fun plan. So anyway, let's look at 3 models, strategies for long-term care planning, and it's all based on your objective. This is huge. Do I want to live in my home while I'm older? Do I mind going to an assisted living? Or do I want to go to a nursing home? So there's people that say, I'm going to use what I have, then I'll go into a nursing home and I'll let the government pay for it. Fine. Okay. But most people want in-home care. This is the #1 choice. In-home care, assisted living usually is #2, and then skilled nursing home is way at the end. Nobody wants that. So I can't blame them. I see it all the time. There's some great nursing homes out there. They do their best, but nobody wants to be there. And the other question is, do you know somebody's going to help care for you? I run into people all the time that say to me, I have no one to care for me. I'm alone in this world. I don't have any family. And I probably run into 2 people a year that tell me that. And I suggest that we start creating a relationship with someone that can help care for them. So there's that need there too. It's very prominent in a lot of people's lives. So anyway, where's the money going to come from? Because that seems like it's always the big problem. Where am I going to get it? How am I going to pay for it? If it's a long-term care insurance policy, if you can qualify for one, they're great. And how am I going to pay for it? And that seems to be a big issue these days. It's always been a big issue. Even high net worth, I have high net worth clients that say to me, I want long-term care insurance. But even then, when they pay for it, they say, well, I know I have to pay for it, and they have the wherewithal to do so, but they never want to pay more than they have to. So which is, isn't that true about everybody? So that's true. So what the objective here is to show them how to pay for it in a reasonable way where they're not overpaying for it, maybe saving some money, or maybe leveraging some of their asset so that they don't have to pay for much at all. So that's kind of a cool thing. So that's what we're going to talk about. So they generally have some type of a retirement account, and they may have an investment portfolio, and they might have some rental income, and they might have an income and pension. So these are generally the assets that we're looking at when we're looking at putting together a long-term care plan and how we're going to pay for it. And if they have rental income, they want to use that. A lot of times they don't. Income and assets, income and pension, if it's an individual, this is usually paying for the individual's home, their electricity, their gas, their whatever they need at their home, their condo association fees, whatever it is. So most of the time we're focusing on these two areas here to pay for long-term care. Okay, so what we're talking about is we're going to leverage a piece of their retirement portfolio and or their investment account. And by doing that, I like to use a particular product. It's a fixed indexed annuity. And I'm going to tell you why, and these next few slides will explain that. First of all, if it's a retirement account and you put a piece of that retirement account into this fixed indexed annuity, it's going to continue to grow tax deferred because your retirement fund is growing tax deferred, and it will continue. We're just going to do a changeover right to from a investment account to a IRA, which would be, and it's going to continue that. If it's an investment portfolio, you're probably every year getting a 1099 from the investment firm, and it's showing you how much you received in interest earned, and you pay taxes. That goes into your taxes, and you pay taxes on it. It goes into your income, so forth. But by putting the piece of your investment account into the fixed indexed annuity, it's going to grow tax deferred because it's an index. It's because it's an annuity, an index, and annuities grow tax deferred by nature. Okay, so but here's what's unique about an indexed annuity. These are common. That's common among all annuities. Here's what's unique about an indexed annuity. There's a thing called downside protection. So it eliminates market vulnerability. So like we saw this year, the market was up high and then it dropped. And if it were up high like this and it became your anniversary date, it wouldn't drop, it just levels off. So it goes up like this. If the market drops, yours stays level. It won't lose money from market vulnerability. Okay, so that's a good thing. It's a great feature. You can be comfortable knowing what you have in there is what you have, and what grows in there stays in there, and it's not going to be affected by the market, the negative market. So it also creates a lifetime income stream. As you notice in bold, because what we're going to do is we're going to take that lifetime income stream and we're going to use it to pay for the insurances, and at the end of and it's going to create a level playing environment so that we don't ever have to worry about where the money's going to come from for this premium. And as you'll see, it's probably easier just to go on to the next slide and talk about it. So why an income stream works well when funding a long-term care plan, okay? An income stream pays out for the lifetime of the annuitant, okay, regardless of whether the annuity has funds remaining over time. So if I put $100,000 into an annuity and 30 years later it hits zero, it's going to continue to pay out. 20 years later, or 15 years later when that hits zero, it's going to continue to pay out because contract is a lifetime income stream. Think of it as a pension kind of thing. So we do have a webinar called Income Streaming for Life. And if you want, you can go online and see when we have those too. That's another webinar, but it goes into a little deeper. But we're going to create a lifetime income stream, and it's going to create an income for the rest of our life. And it's an important thing to remember. Okay? If the annuitant deceases prior to exhausting the annuity, so in other words, if we had $100,000 in the annuity and $50,000 was paid out, all right, the remaining value, $50,000 plus the interest, would be returned to the beneficiary. I know there's a misnomer out there that annuities don't pay for when you have an annuity and it runs up. If you die, it's a misnomer. If you die and you don't get your money back, there's only one type of an annuity, and that's an immediate annuity without refund. And there is a place in this world for that. I've used them before, but there's a place for them. And we're not going to get into it right now. We can get into it if you want later. But that's not this. If you don't use all your money, it goes to your estate or your beneficiary, whoever your beneficiary is. Okay. Again, another reason why since the premiums are being paid by the annuity, this is the insurance premiums, okay? It's being paid by annuity with a lifetime income stream. The income continues even though in the standalone long-term care policy, the claim after so the standalone long-term care policy, when you go into claim, here's the claim word. When you go into claim with a long-term care insurance policy, you stop paying premium. Okay, so your family member needs to activate their insurance policy. You call the insurance company up. Doctor gives you the letter. You go through the elimination period of say 60, 90 days, and then you start receiving money, you start getting refunded by the money from the money. It's a reimbursement. You get refunded the money that you put in. So at that point, you're not paying any more premiums. So here you are. You've got an insurance premium of $5K, and you've got a lifetime income stream paying out income stream of $5K. Okay, so you stop paying the premium, but the income keeps coming out. So now I've got money coming out of my long-term care policy, but I also have money coming out of that annuity with the income stream because it's an income stream for life. So I've got two buckets of money I can use. So virtually, if I know I'm going to need that long-term care plan for a longer period of time, I can use the money here and stretch out the long-term care policy so I can use it for a longer period of time. Or I can just do the opposite. If I know that the individual I'm caring for isn't going to be needing that long-term care policy, or I think they're going to be passing away and never going to need that long-term as much, I would save the income stream and probably put that in a different bucket, maybe an account somewhere, and then I would use this insurance policy as much as possible. So it's just giving you another bucket, which is a wonderful thing. When you're always looking for, when you're getting reimbursed by long-term care companies, you need some cash flow going on. So it'll help create some cash flow. Okay. So the other thing is, when I'm using an annuity with a lifetime income stream, the cost of the plan will never exceed the funds I place in the annuity. Right. So if I put 100 grand into this annuity, right, and my premium is $5,000 a year. Okay, this has got to grow based on the allocation. I know that, but this 5 grand, if it never grew, it'd be exhausted in 20 years. Okay, so now I would be down to 0. But since it's an income stream for life, the 5 grand continues to be paid out. So I know, even though this is growing, and it might take 30 years for it to get to 0, after that 30 years, if I've used my 100 grand plus my interest I've earned, it's now 30 years later, I'm still paying this 5 grand, but it's coming out of my annuity, which is an income stream for life. So the only thing I put in was 100 grand, plus I'm using my interest. So I minimized my need for cash or funding of this annuity, as opposed to just taking the $5,000 out of my cash flow every year, out of my pension, out of my income every year, and just paying it out of pocket, which it could end up being a lot more than $150,000 to $200,000. Okay, we see that all the time, and this is where people with wealth I mean, I talked to you about those individuals, high net worth clients that like long-term care policies because they understand them, but also they understand the fact that this theory here minimizes the amount of money they need to take out of their investments to fund their program. So we're going to put some numbers to that. Let's talk about that. So right now, basically, let's review leveraging. All we're doing is taking some money out of a retirement account or an investment account or a piece of each of it. We're going to create this income annuity. The income annuity is going to give us a lifetime income stream. Okay? So this is the last time we're going to talk about that, because we're just going to focus on what we're going to take it from one step forward. So now We have a traditional long-term care policy. This one here basically says that I have the annuity with a lifetime income stream, and it's paying for my life insurance policy, my long-term care policy, just as we mentioned in the last few slides. Let's put some numbers to it. So this here is a joint income annuity. So it's a couple. It's John and Mary. Let's call them John and Mary. And they had to take $183,000. This is an actual case that I ran. They took $183,000 out of their investment or retirement account. They created a $6,039 annual payout. That payout is paying a $5,962 annual premium. Now, we set it up so that they can go on vacation, they can enjoy their retirement, and they never have to worry about this because we put a checking account in place. The money goes into the annuity company, sends it to a checking account, and the long-term care insurance company takes their premium out of it annually so that they can be in Europe having a grand old time or somewhere in the Caribbean cruising, and they don't have to worry about paying their long-term care because it's on automatic pilot. And it's a nice setup. And they also know that they're never going to have to worry about how they're going to pay for their long-term care policy because they put the $183,000 in. It's doing what it needs to do. End of story. So the next one is, how do I get my money back if I want to minimize my cost? Model 1, the person put the $183,000 and said, I'm not worried about it. Let it go. I don't have to get the money back. I'm good. Okay. So this one here, the couple said, well, I want to get my money back. Okay, cool. So the lifetime income stream, it's paying for a traditional long-term care policy like John and Mary, call this John and Mary. And they're also paying for a permanent life insurance policy. It's a GUL, and it's like an extended term. It has a very little cash value. If you have to do any Medicaid planning, it's a perfect tool for that. So we'd use a GUL. Usually it's the second to die. So when the second spouse passes away, it pays the estate a death benefit. Okay, or the beneficiary. The estate's named the beneficiary. So it pays that. So let's put some numbers together for this so you can really see how it works. I'm going to tell you a story about another one. So anyway, again, it's John and Mary. So we've got a joint income annuity. They put $300,000 in it. It's creating a $9,900 annual income. It's paying, out of that, it's paying $5,962 for their traditional long-term care plan. And this is for both of them. And it's a shared plan. And a shared plan is really cool. That means if John doesn't use his benefit, it goes to Mary, or whatever he doesn't use, it goes over to Mary. And if Mary needs to share some of her benefit to John, she can share a portion of it to John if he uses all his on his own. Get into that later. We have another webinar called Understanding Long-Term Care Policies. So that's a cool thing. It's a cool option. But this strategy here also has a permanent life insurance, like we said before. It's a $300,000 face value, and the premium is $36.41. So the $9,900 is also paying the $36.41. And at the end of the day, when both John and Mary pass away, their beneficiary, whether it's their estate or their children, are going to receive $300,000. So what do we have here? We have $300 in. We have a long-term care policy. We have a life insurance policy. The premiums are paid for. And at the end of the day, we're getting our $300,000 back. Okay? $300,000 out. Well, good strategy. Like it. Take it one step further. So I have a client that said to me, I like the strategy. He said, but I want money on my $300 grand. I just took $300 grand and I'm going to give it to you for God knows how long. And it's going to go into this annuity. And I understand that the income thing and how it's going to, the lifetime income stream and how all that works. He says, but I still want some money from my $300 grand. Well, he was a single individual person. So let's redo this numbers. His annuity was initially for $120, all right, and he would get $120 back. But he said, I want more than that. I want return on my $120. So we took $150,000, okay, and we created a $450,000 permanent life insurance policy. That $450,000 now pays out upon his death $450,000 to his beneficiaries. Okay? So now he took $150 and he's getting $450 back when he died. His family's getting $450, or his estate, whatever it's set up, is getting $450 back. So what happened now? So now he has a traditional long-term care policy. In fact, it's a really nice one. It's a really cool policy. But that's paid for. And then at the end of the day, it's all coming back to his estate. So all he did is leveraged a piece of he had inheritance actually. He took $150,000 of his inheritance and he leveraged it, paid for a long-term care policy. He's got a lifetime benefit, and his family's getting the money back. So all he did is he's using it while he's alive. So a lot of times what I'll ask a client is this: are you planning on leaving the $150,000 or the $300,000 to your family when you pass away? Do you plan on at least leaving that to them? They go, of course I do, of course. So I said, well, why don't we, while we're alive, take that piece and leverage it so that we can use it while you're alive, and at the end of the day, your children, your estate, whatever it is, your charity is going to get that money back threefold in this situation. So that's a great strategy, and it's been very successful with a lot of people, and it's helpful. There's another strategy we have, and it's a hybrid life insurance policy. And this is a solution that the industry came out with because one of the things, and I'm sure you've heard it or you may be thinking it, is that when you have a long-term care policy, then if I don't use it, I never get anything back. Well, Model 2 kind of blows that out of the water. So Model 3 is the insurance industry's answer. They took a life insurance policy and added a long-term care rider to it. Now, it's important to understand this. I'm going to tear this apart a little bit, and it's important. A long-term care rider is not to be confused with a chronic or critical care rider. Two different animals. A long-term care rider is qualified, meaning it's tax qualified. So the IRS sends you, the IRS sends you a 1099 every year for the premium that this long-term care rider costs. So the rider costs money. And on a policy of $500,000, like $1,000 a year, it's not huge. Okay, you have to qualify for it. So you have to go through underwriting. Whereas a critical and chronic care rider, there's no underwriting. It's attached to a life insurance policy in Massachusetts. It's required. It gives Medicaid, and right on the form it'll tell you, it gives Medicaid the opportunity, if you have cash value, or if you have a policy, it gives them leverage against the life insurance policy if they need to leverage it for your care in a nursing home. So it needs to be tax qualified, it needs to be money, and it's underwritten. But also the agent that is offering you this long-term care rider, they have to have a life license, a health license, and they have to be certified in long-term care. Okay, so if they're not certified in long-term care, they can't represent it. So a lot of times, life insurance policies and critical care riders can be misunderstood or misinterpreted. So it's important to understand these four things when we're looking at that. But again, I'm drifting off the subject, and I'm getting a little more into a different webinar that we do. So anyway, in this situation, we have the income stream, which we talked about, and it's paying for the premium for the life insurance with the long-term care rider. And that's giving us a long-term care rider. It's giving us policy value, which is cash value. And it's also whatever's left over at the end of the day, it's going to our beneficiary, whether it's the estate or our children. Okay? So if I have a $500,000 life insurance policy, and I only use $200,000 over here, the $300,000 is going to my beneficiaries. Okay? 5 minus 2 is 3. Okay? And we're going to get into a little deeper on the policy value, because the policy value can be used in a couple of different ways. So let's go put some numbers together so you understand better. Okay. So it's a life insurance policy, so it's an individual. It's not a joint. All right. So we've got an individual. They put $200,000 into that income annuity. It's generating $8,600 of annual income. The annual income is that annuity is paying for the $8,500 premium, and it's got a $500,000 face value, and the long-term care benefit mirrors the face value. So you've got a $500,000 face value and a $500,000 long-term care rider. The entire $500,000 can be used for long-term care purposes, minus 2 ADLs, the whole 9 yards. There's no cost of living rider on it, and it doesn't, you have to continue paying the premium until you pass away. It doesn't have that feature that a standalone policy would have, whereas when you go into claim, you don't have to pay for it anymore. You have to pay for this till the day you pass away. Okay? So, but the feature of this one here is nothing's left on the table. If I don't use a portion of it, it goes to my beneficiary. If I don't use any of it, the $500,000 goes to my beneficiary. We also have a policy value, and I said it's cash. Okay, so this can be used for anything. So you could have a level one, or you could have an increasing one. The increasing costs more, but it has a feature in it that you might kind of like. The level, if I have a $500,000 face value, and I have $200,000 in cash value in here, okay, and I die, and I never use the long-term care rider, the $500,000 goes to my beneficiary. And if I use the long-term care rider, well, we take that out of the 500, and whatever's left goes to my beneficiary. If I have an increasing, okay, if I never use for long-term care, the 500 goes to my beneficiaries, and the cash value goes to my beneficiaries. This is increasing. Okay, level 0 to beneficiaries. Okay, so that's important to understand. So if I had 200 grand and I never used the policy, my beneficiaries would get $700,000. If I have a level plan and I never use the $500,000, my beneficiary is going to get $500,000. And not to talk this to death, but if I use any of that long-term care, it's going to come out of the 500 or the 700, and I'm going to get the remaining value. So nothing's left on the table. So that is the insurance company's, the insurance industry's solution to people that say, if I don't use it, I lose it. And you don't in this situation, but it's using a different vehicle. So that's an important thing. So what do I say about that? Compare, compare, compare. Because I'm going to tell you something. When we compare Model 2 to Model 1, Model 2 to Model 3, 9 out of 10 times Model 2 is preferred. I don't know. It just became, I think Model 3 was just convenient. It's easy for people to understand. It's less dynamic, but Model 2 generally. So I have to say, make sure you compare, you compare, you compare. Huge, all right? And when you do that, you'll see which one best fits your objective and how it's going to work for you. And we get into the dynamics of each one because they do have different components that you need to know about, but we can get into that another time. So anyway, what do we here? Where do we go from here? Well, we're here for you. If you currently have a policy, a long-term care policy, an insurance policy, a life insurance policy, or whatever that you need to look at and you need some help with, we're here for you. We're more than happy to do some reviews. If you need a long-term care policy, we have certified long-term care specialists like myself available to talk with you, and we can help you out. We can do it virtually, however you feel comfortable. And then we can also do free consultations to our members, and our membership is free. So we've made it pretty convenient for people to use our services because that's what we want. We want you to use our services. We want to help you understand what you're getting into, what you're involved in, and how we can set up that plan for you. So give us a call. We'll do free membership, free consultations, and we'll help you figure out what you have, what you need, what you don't have, and go from there. Well, how do we get a hold of us? Okay, you can email us at information@RERCNA.com, or you can call us at 617-982-3692, or because you're on this webinar today, you can call me directly. My number is 508-353-2524. Okay? Feel free to call me. We can talk and chat, and we can go from there. But again, we're here for you, and we hope you enjoyed the webinar. And if you have any questions, feel free to call us. Do we have any questions? Okay. So it looks like we've covered everything we need to do today, and I hope you enjoyed the webinar. And again, reach out to the Retirement Education Center for anything you need. We have other webinars, income streaming for life, understanding long-term care policy. We have other topics as well with Medicare topics with Peter Stoner. We have a few others on that we're generating over time. The COVID environment has really pushed us into an area where we're having to create virtual programs. So here we are, and we're doing it. So call us if you need us, and we're there for you. And thank you for joining us. Take care. Bye.